Good morning from London. I'm Kriti Gupta alongside Mackenzie and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. President Trump threatens a 35% tariff on some Canadian goods and raised the prospect of higher blanket tariffs on most trading partners. Meanwhile, JP Morgan CEO Jamie Dimon says the markets are simply too complacent about the threat of tariffs, going on to warn that Europe is losing the battle to the United States and China. Meanwhile, Britain and France have agreed to exchange migrants as part of a plan to deter illegal crossings by boat. It marks a broader effort to deepen cooperation between the two countries. Val.
Let's check in on how these markets are faring an hour before the opening trade here in London. We're in the red on both sides of the Atlantic. S&P futures down 0.3%. Euro Stoxx 50 futures falling as well. Euro dollar on a back foot below the 117 handle. Euro has weakened around 0.8% this week. Dollar strength on the back of these tariff threats is really upending this dollar weakness trade. We also have U.S. 10-year yields hovering at 4.35, unchanged on the session. The countdown to the opening trade starts right now.
It's a Friday, it's a summer Friday, it's a European summer Friday, and yet there's still plenty of news to digest. Of course, no surprise, it is coming on the tariff front. And I think that's where we start today. The news from overnight from Donald Trump himself talking about some pretty scary numbers. 35% on Canada, 15 to 20% on everyone else. But there are exceptions. There's some fine print. There's some asterisks in the contract, or at least what he's talking about. These comments coming from NBC. Let's start with the Canada piece, and we'll talk about the blanket tariffs as well. This is a scary relationship. We know tensions have been high between the two countries as well. He's talking about increasing on USMCA non-compliant goods, going from 25% tariffs to 35%. Val, you and I were talking about this morning. Do we think this matters?
Well, look, the USMCA compliant goods make up a majority of Canadian exports to the U.S. So in some way, it's not going to have a huge market impact. We saw the Canadian loonie move around 0.2% off the back of this. For me, it was really the comments that Trump made to NBC about the universal tariffs that are currently at 10%, and he's threatening to up them to as much as 20%. Tom, that could be something that could really flip this narrative from, one of U.S. economic resilience to, recession warnings coming back front and center.
This is a repricing in terms of what the markets need to do if the baseline comes in at 15 to 20%, so potentially double what had been assumed in terms of the ultimate outcome for most nations of 10%. And so that is where Val's focus is. And you move very quickly on from Canada because of some of the exceptions. Oil remains at 10% for Canada. You have all of those products that fit into that existing trade agreement between the US, Mexico and Canada that are not impacted by the 35%. But Trump has seen blood in the water when it comes to Canada in terms of the removal of that digital services tax by Carney. He did that. He removed that under pressure from Trump. Maybe this is another pressure move and it's a challenge for Carney. But to your point, the broader impact across the global economy, the focus for you, Val, is on that 15 to 20%.
No, but a question is, why is Trump upping the stakes when it comes to Canada? Is he trying to open up this USMCA renegotiation? Yeah. I mean, I thought we covered that all the way back in February and March, but maybe this is him wanting to bring the USMCA renegotiation back on the table. He wants to get it done sooner rather than later. It's up for renegotiation next year, so maybe this is him attempting to bring that on the agenda.
And the precedent's really crucial here because when we're talking about what's actually the exposure, it's cars, it's a little bit agricultural goods, it's oil as well. A lot of that's Mexico exposure as well. So I wonder how much the market extrapolates that question. There's also a piece here of what is cost prohibitive. 10%, the narrative has been, well, we can digest that. Corporations can eat that cost. 15, 20, 35. The likelihood of that is crucial. But the markets, you mentioned a small move in the Canadian dollar. Not blinking an eye beyond that.
I mean, when the headline crossed about the universal tariff, S&P futures dropped around 0.6%. That's it. I mean, the narrative around the equity market being resilient around this tariff threats this week really does continue. Yesterday, you had the S&P 500 closing at all-time highs. It scraped through marginal gains for the week, but most people are finding this very incredible because last time Trump upped the stakes when it came to tariffs, we saw this Sell America theme dominant through global markets. You had U.S. equities in the red, the dollar in the red, treasuries down. We have not had that. It's been nearly the opposite. And I think the dollar move is confounding a lot of FX traders. We thought that we would have the dollar continuing to slide on continuing to slide on these new tariff threats. And we've had the opposite this week. Euro has moved lower by 0.8%. I mean, I'm finding this very confounding.
I mean, the dollar has confounded on both sides of this story, right? April the 1st, dollar moves lower. The expectation had been that would be a haven gain on the back of that story. Now it's higher. So the narrative around the dollar is really interesting, how it's misfooting or at least challenging some of the assumptions. In terms of the market resilience, is it resilience or is it, as Jamie Dimon suggests in that conversation in Dublin, complacency in these markets, Kriti?
Yeah, it's fascinating. He's talking about complacency, but he warned about this even before Donald Trump's election and making a very large swath of comments saying that right now things are fine in the States, but it could get worse, making these comments, I believe, on Fox News with Maria Bartiromo. I think it's also crucial some of the other things he mentioned. He said, look, the outperformance of the United States may still be here to stay. He talked a little bit about the fact, I think he called the Europeans losers, basically saying they aren't able to compete on the same level that the United States and China is as well. He even went on to talk about the fact that if things get worse in the future for American politics, he might consider running for president. So lots coming on from Jamie Dimon. But from a markets perspective, I think really echoing, I think, what we've seen from a lot of the folks around this table, that complacency is the name of the day.
He did also mention that he is penciling in around a 40 to 50% chance of the Fed hiking. So he is clearly
so let's just put a pin in that.
Let's
just put a pin in that. Hiking. Valerie did not misspeak. That's what Jamie Dimon said, hiking.
Yes, he is worried about, he's anticipating firmer inflation later this year because of tariffs. And, maybe this universal tariff threat overnight is only going to increase that chance in his mind of the Fed hiking. But I think it goes to show that a lot of what he said, it tends to be what market participants agree with. Why is the equity market doing so well? But you take a step back and you think about if the U.S. equity market isn't watching the tariff story, what is it paying attention to? Yesterday, it was paying attention to tech headlines, to the AI story, CapEx spending, investment that we're hearing from these Mag 7s is continuing. It was also listening to Delta earnings yesterday, which was kicking off the earnings season, which is going to come in full force for the U.S. in the later bits of this month. But the Delta earnings held up okay, and the U.S. equity market took that in stride.
Reinstating their guidance after suspending it on the uncertainty as well. We'll see if the narrative changes. Look, again, it's a summer Friday. It's a European summer Friday. But in September, a seasonally risk-off month, historically, maybe we'll see a little bit of this come to some fruition, some of the warnings that Jamie Dimon has been presenting. Let's talk about what's going on in this region, specifically right here in the UK. We did see some headlines crossing the Bloomberg terminal just briefly around the GDP data. It looks like the UK economy, unexpectedly contracted by 0.1% in May. This is a big deal because the estimate was a 0.1% rise. Tom, you pointed out this week in the pound just a little bit, but not the only thing we're watching in the UK space.
Yeah, pound down 0.3% on this line. This is the second straight month of contraction. This is bad news, obviously, for the governing Labour Party. Are we getting close to a recession story in the UK on a week when the OBR, the Office of Budget Responsibility, comes out with a red flag on the sustainability or lack thereof of the UK's finances? The only elixir to that, the only saviour to that would be growth and significant growth. We are not getting that in this UK economy. So just to underscore the challenges for this Chancellor as she leads up to that autumn budget, this is not good news on the data front. Politically, a bit of a win for Prime Minister Keir Starmer yesterday in this agreement with Macron on migration. And look, this is a political story. It's a domestic story for the UK. But it talks as well about the shift to the right in terms of the polling that we're seeing for Nigel Farage's Reform UK party. And arguably the right shift as well in France. So trying to address that with the migration story is this exchange, one for one. We will accept migrants from France. They have to go through a vetting process, but those who arrive on boats will be taken back. It's a pilot scheme to start with, but it's a win for Prime Minister Keir Starmer on the domestic political front. Will it go anyway to adjusting the polls where you've seen that massive surge for Nigel Farage and the Reform UK party in terms of that lean into the UK migration story? On the other front, and I'll briefly touch on this, I think this is really significant as well. France and the UK aligning on their nuclear capabilities. France has historically been very set on having its own sovereign and independent nuclear capabilities, and it hasn't shared those with NATO. Now it is prepared to share that with the UK, and we know other European countries are interested in a joint nuclear umbrella. Germany is not a nuclear power. When it comes to nuclear weapons, it has shown and expressed interest in UK-French capabilities. So that is significant on the defence front.
It's a fascinating one as well. You talk about the nuclear capabilities. We know that this week, not just between UK and France, but there's been plenty of questions and conversations around things like sourcing, things like F-35 jets, for example, something that the UK has been struggling with here. Let's talk about what we've got coming up on the show. An all-star lineup on this Friday. Becky Quinn, Fidelity International multi-asset portfolio manager, will be joining the program in just a few moments. Sonia Martin as well, DZ Bank FX research head, is going to be as well. We're going to hit this from a stock perspective and from an FX perspective. What is more complacent? Maybe both. Patrick Armstrong, I'm sure, has views on that as well. Plurimi Wealth CIO. And then, just for Tom Mackenzie, we decided to bring on the Amazon managing director for EMEA. Tanuja Randery will be joining the program as well, talking to us about where we are in that European innovation story.
Let's look at the risk events we have on the horizon today. We are wrapping up over in Malaysia, the Association of Southeast Asian Nations. The foreign ministers meeting wraps up today. There's going to be a key meeting between the U.S. Secretary of State Mark Rubio and his Chinese counterpart due to take place around 8 a.m. London time. And then heading over to Germany, the Chancellor's tax break package is expected to get the final ratification in Germany's upper house later this morning. At 1:30 p.m., our eye goes to the Canadian payroll data, the unemployment report coming out of Canada. We do get some Fed speak, and then at 7 p.m. later tonight, the federal budget balance for the month of June from the U.S.
It's fascinating. We also have this idea of, you started off with this with the ASEAN foreign ministers meeting as well. We should flag to everybody that we are due to see a meeting between Marco Rubio and his Chinese counterpart as well. Does that pave the way, perhaps, for some sort of conversation between Donald Trump and Xi Jinping?
Yeah, perhaps a potential meeting, whether that's going to take place in China. Trump has floated an idea of going to China.
Would that be a catalyst for the markets, Val, if you had a meeting between the two presidents?
Definitely.
It would suggest there is a real easing, at least on the top level, in terms of these tensions. And it seems like they are moving towards that.
Yeah, look, I would say that any top-level conversation between the President Trump and Xi Jinping would be positive for risk assets and for what the markets assume to be, the trade negotiations coming to some conclusion rather than dragging on for his whole presidency.
Yeah, it's a fascinating one as well, because we know that I think it was a couple weeks ago where Donald Trump had said, we are hitting some sort of agreement, some sort of deal with China. No understanding of what was in the deal, no understanding of what the timeline of that looks like. So maybe we get a little bit of insight after this meeting. Yeah,
for now they have, it seems, on both sides made moves to implement the previous agreement, of course, that was come to here in London between the two sides. Here's what else you should be thinking about this Friday morning. Bloomberg has learned that Citadel Securities has bought Morgan Stanley's unit focused on electronic market making for U.S. equity options. Sources say the trading firm, founded by billionaire Ken Griffin, acquired Morgan Stanley's on-exchange options business and took on a large portfolio of equity options positions. The move expands Citadel Securities' already dominant role in the popular derivatives. JP Morgan is considering cutting the weight of the largest bond issuers in its flagship emerging market index, including China and India, as it seeks to reflect a broader range of developing nation debt. Sources tell Bloomberg the Wall Street Bank has been soliciting feedback from clients on changes to the index, which serves as the benchmark for local currency developing nation debt that is tracked by more than $200 billion of funds. And President Donald Trump says he plans to make a, quote, major statement on Russia on Monday. Trump shared the news in an interview with NBC, adding that he expects the Senate to pass a tougher Russia sanctions bill and reiterating his criticism of President Vladimir Putin over the continued attacks on Ukraine. The comments come as the US prepares to send more American weapons to Ukraine through purchases by NATO allies.
Lots to watch going into this weekend. Coming up on the program, London has always had its own food culture, but isn't New York influence creeping into restaurant trends? We're going to discuss what a New York influence actually means. Maybe some good, maybe some bad. Plus, of course, a focus on tech. We hear the SAP CEO's thoughts on the need for more European data centers. This is an exclusive sit-down with our very own Tom Mackenzie, who will sum up some of the learnings from that interview as well. Up next, though, right back to what Jamie Dimon is thinking. Are the markets too complacent? Will the tariff story have an actual impact? We're going to dive into that next. If you have any questions of your own for us or for the guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
it feels like markets have almost just adjusted to this, these big headline numbers when it comes to tariffs.
Financial markets are just looking for clarity around the distribution.
Kicking the deadline out to the 1st of August, though, does mean that with the new tariffs, so the incremental increases, they probably won't show up in consumers' shopping baskets until after Christmas.
If uncertainty picks up on the tariffs and we start to see the first signs that in the hard data there's some negative impacts, I think the market might question that Goldilocks pricing that it currently has.
I am just getting a little bit worried that, where we could end up is not really an average tariff rate of something that looks more like maybe just a shade above 10%, but maybe we'll end up with something that is just a shade below 20. And there is a difference between those two numbers.
This isn't the 1930s. This is unilateral action by the states, not a multilateral collapse of the global trading system.
OK, some of our guests on the show this week weighing in, of course, on the tariff news this week and showing some angst in terms of the equity market positioning. And so far, that is not being reflected to a significant degree across the stock markets. Val has been charting this for us as the trade, of course, headline risk continues. And yet the equity markets continue, at least not in the session today, but generally this week, have pushed higher, Val.
Yeah, Tom, I mean, it was really this chart that did it for me this morning, really comparing what drove the equity market fall in April to how resilient it's being now. If you take a look at this chart behind me, this white line is an inverted index of global trade policy uncertainty. You can see in April, uncertainty climbed and the U.S. equity market plummeted off the back of that. We are not having the same correlation when it comes to this week. We thought we were going to get some clarity when it came to tariffs, but it's really just another bout of uncertainty, at least not overnight. We've heard from Trump in an interview with NBC threatening to raise the universal tariff to 20%. So as this uncertainty is rising, the U.S. equity market is continuing to rally, really confounding investors this week. Also, take a look at the Bloomberg Dollar Spot Index. It's having one of its best weeks since Liberation Day. That's also an inverse correlation we didn't think we were going to see this morning. But this second chart behind me is the average U.S. tariff rate for the month of May. The average U.S. tariff rate, Kriti, was around 9%. Now we have to worry about a potential doubling of this with the latest threat from President Trump to take that universal tariff all the way up to 20%.
Or potentially even higher, depending on how the rest of the world feels about Donald Trump, how Donald Trump feels about the rest of the world. Valerie Tytel, thank you so much. Let's get a little bit more analysis here. Becky Chin, multi-asset portfolio manager from Fidelity International, joins us around the table. Becky, pleasure to have you this morning. Talk to us about this kind of idea of what the stock market maybe should be pricing in that maybe they're not.
Sure. Obviously, we've seen the market ignoring largely the volatility around tariff announcement. I think it's fair to say that when news as such comes up the first time around, like Liberation Day, it tends to cause much bigger chaos, and the second time round market come to see this type of news. I think for us, it's worth bearing in mind that seasonality is still pretty strong, and as volatility remains low, the systematic community remains somewhat neutral on risk, so they have still room to re-risk that automatically start to take place for as long as volatility stays low. However, so whilst that keeps us wanting to stay invested in the market, we are putting in the portfolios ample hedges just in case volatility sticks up again, and that is by way of put options, for example, defensive FX, for example, like the yen or gold. And we believe that, well, a colleague and mentor once told me, it's not about where you invest, but how you invest in a world where uncertainty is quite high and correlations on a backward-looking basis is not to be relied upon. And so having part of that hedging policy in the portfolio allows you to express more conviction views on the long side.
How expensive is it to hedge right now when everyone's kind of waiting for the straw to break the camel's back? Sure.
You definitely see a little bit of volatility term structure picking up around that 1st of August deadline. Well, if it is really going to be a deadline. But if you look at overall volatility level, it has been coming down and it's not exorbitantly expensive. And you can structure put option strategies either via straight put or put spread, so that is not going to cost the portfolio too much. And also because the stock market has done reasonably well in the first half, you can actually afford a little bit of premium to give you that protection if volatility really picks up.
Becky, as we look ahead to earnings season and the debate as to how much is absorbed by corporates in terms of the tariff impact, whether on margins or the pass on to consumers. And we heard that debate articulated by the Fed's Mary Daly. Do you zone out the companies that have more exposure to tariffs in terms of the potential squeeze on margins? How do you think about that? How much transparency do you have in terms of calculating the tariff impact to corporates in this earnings season?
Sure. I think there's a lot of lack of visibility, suffice to say, in terms of what tariff policy will eventually come to, because we still think, even though most of the letters look quite similar to 2nd of April, but eventually the effective tariff rate, we think, will settle around 16%. And we think the upside risk that if it is closer to 20%, it will bring us a lot closer to a potential recessionary outcome, non-linearity, than the 16%, which is below trend growth. And that has a vast impact on companies' earnings as well. So for us, it is, like you said, steering clear of companies that are very exposed to tariffs. So, for example, in Europe, whilst we have very positive rumors recently about potentially a trade framework with the US, but we're still focusing very much on either the thematic side of things, such as European defense, which has multi-year earnings growth potential, or we've put on a German domestic theme in the portfolio, where you've got purity of earnings exposure to European fiscal, German fiscal policy, but also you're positively exposed to higher euro and less exposed to a flare-up of trade uncertainty.
Do you worry about the consensus nature of those trades, European defence?
To be honest, if you think about much of the defence performance has been driven by PE, but the earning trajectory is multi-year, and we've seen some of that trade flow around the sector theme fade somewhat around NATO meeting, but actually start to come back a little bit. So I think there is durability in the earnings story, and the PE will see a little bit of volatility, but we're happy to be exposed in that sector.
Becky, you mentioned that you're seeing the effective tariff rate, settle around 15 to 17%. What do you take of Trump's comments overnight about possibly increasing the universal tariff rate up to 20%? Is that something that would almost guarantee a U.S. recession in your mind?
I think the news and narrative around tariff has been exceptionally volatile. To be honest, it's difficult to say where, where the eventuality effective tariff rates may be. That's why we're saying we think the base case is around 16%, but if you add on all the extras such as critical sectors, BRIC, universal tariff rate, etc., you can push well above 20%. That's why, from a macro base case perspective, we're looking at a stagflationary outcome defined by below trend growth and above target inflation, but we're not ignoring that tail risk of potential recessionary outcome. Or if not recession, eventually this initial inflation impulse get pushed over by a collapse in demand because essentially it's too much of a tax on consumer. So I think that tail risk cannot be ignored. Given the
so at what point do we start ignoring worries about tariff-induced inflation and start way more focusing on the hit to growth? Is that 20% range?
A stagflation risk at 20% if that's where the baseline settles. Becky Chin, thank you very much indeed. Multi-asset portfolio manager at Fidelity International. Coming up, trade tensions rise, of course, as we've been discussing, as President Trump threatens that 35% tariff on some Canadian goods. We're going to discuss the impact on FX with DZ Bank's Sonia Martin. That's coming up. This is Bloomberg.
Thirty minutes from the start of the opening trade. When you take a look at the futures picture, I'm going to try to say that right. The U.S. futures are fairly negative at the moment. I think Europe is getting the same vibe. The underperformer this morning is the Euro Stoxx 50 futures. FTSE 100 is flat at the moment. We'll see how much of that is just really a reversal from the move that we've seen in the commodity complex earlier this week. We'll see if it sustains, but it's Friday. It tends to be a risk-off kind of day of the week going into the weekend. So we'll see if that sustains into the open, Val.
Yeah, let's check on the European fixed income open. We're seeing a small rally across the curve when it comes to Germany and France. Those yields are down around nearly 2 basis points for German 10-year. But really the theme of fixed income this week is just how well all the supply has been absorbed. We had a 30-year bond auction last night in the U.S. that took down really well. Also some Japanese auctions this week that were also absorbed very well. So it does seem like the fixed income market is being able to absorb all the supply even in the quiet summer months.
And we'll watch gilts, of course, at 8 a.m. on the back of that softer than expected GDP data out of the UK. Do we start to price in more cuts from the Bank of England? Meanwhile, President Trump, of course, has dropped a fresh trade bombshell, of course, with his sudden announcement of plans for a 35% tariff on Canadian goods from August the 1st. The rate is higher, of course, than the 25% announced in April and comes despite ongoing negotiations between the two sides. For more, let's bring in Bloomberg's news desk editor, Jill Desis, who has been monitoring this for us. Jill, how much of an escalation is this in reality when it comes to those ongoing US-Canada tensions?
Well, Tom, I'm glad that you mentioned that 25% figure there from earlier, because I would say that this is somewhat of an escalation, but this is more modest than what, say a 35% across the board tariff would look like. I think what's really important to remember here about this is, so what we've been hearing is that this 35% increase, that wouldn't affect anything that's, been already been negotiated under the USMCA agreement. So that's the, the U.S. Mexico-Canada Free Trade Agreement. So, really, really important to remember that there. So effectively, we're talking about an increase of about 10% over that 25% tariff on some Canadian goods. That was what Trump brought up several months ago, saying, tied to a lot of his criticisms over, Canada's role in fentanyl trade and such. So that's what we're looking at on the Canada side. What I would say, though, is that when you're taking the entire week in aggregate here, Trump has clearly been escalating a lot of his rhetoric about trade. This just compares to even just at the start of the week when we had that delay to that August 1st deadline. Remember, originally the reciprocal tariffs that he had imposed on a bunch of nations that was ultimately due to expire this week. We've got a few more weeks of negotiations that's ultimately happening here. But, back at the beginning of the week, Trump was saying that he wasn't completely 100% firm on that. Now, though, it seems like, he's really, really kind of doubled down on his economic policy here. It's not just Canada. We also had that 50% tariff threat that he, floated against Brazil the other day. So really, I think Trump is trying to, go a bit more hard language on some of these tariffs as we wind up to that August 1st deadline.
Well, speaking of the August 1st deadline, Jill, he also talked about a blanket tariff, taking it somewhere between 15 to 20%. How cost prohibitive is 20% versus 10?
That is Kriti, that's a pretty big difference there, I think. And again, it's really difficult to tell with Trump just because so much of this still feels like it's really in flux. If we're talking about a blanket 20% tariff versus what he was threatening earlier this year, that 10% baseline, I think, that changes the calculus here. But the other thing that's a bit still, confusing, and I think that we really have to keep in context, is that it's not just about, whatever he imposes under a blanket tariff. It's also about what kinds of tariffs, he's imposing separately on all these countries. Remember, this is a president who, over the past week, has been sending out letter after letter to all of, the U.S.'s trading partners around the world, saying this is, what your tariff rate is unless we can negotiate something differently. Some of those rates are a little bit higher. Some of them are a little bit lower. So that's kind of difficult to parse there. But then in addition to that, I think, we just had a graphic up on your screen a couple of minutes ago showing that, there's also these sectoral tariffs that are coming into play. 50% on copper, we're still, I think, trying to figure out exactly what that looks like, what types of copper are ultimately covered here. We've got sectoral tariffs on steel and aluminum. We've got the threat of pharmaceutical goods. So it's not really just about that baseline. It's also about what happens with some of these sectoral tariffs. And the one thing that I really, want to continue to point out, as you're seeing it on your screen right there, the one thing that I want to continue pointing out about those sectoral tariffs in particular is that if those are coming in under, investigations done by the U.S. Commerce Department, I think that those are a bit more sticky than, with some of these more executive order level decisions that are being taken on a country by country basis. So I think we have to see how that's evolving over the next weeks and months, sort of as the White House finesses its tariff regime.
Okay. Bloomberg's news desk editor Jill Desis Thank you for getting us up to speed on the latest lines around these tariff threats, of course. 50% on copper, 35% on Canada, at least certain exports from Canada to the US. Staying with Trump's tariff clash with Canada, let's get more on the impact of the trade headlines on FX. Joining us now is Sonia Martin, Head of FX and Monetary Policy Research at DZ Bank. Sonia, thank you for waiting in the wings. Thank you for your patience and joining us this morning. We were discussing the role of the dollar post-Liberation Day. Well, of course, you saw that weakness come through for the greenback on a pretty sustained basis. Now that has reversed. We're seeing a revival of spirits for the greenback. Explain what has changed fundamentally for the dollar, and if the strength that we've seen in the last week or so has further to run.
Well, to be honest, I mean, when you put it like that, it doesn't really make particular sense that we have seen the dollar recover some ground recently with the news flow that we've been getting. I would say that if you look at the performance of the dollar since the beginning of the year, we have seen a massive depreciation that's been running, pretty much throughout the first 6 months of the year, or actually, until a couple of weeks ago. So I would not overstate the size of the move that we've seen recently. It's been a bit of a bounce back, but the dollar is still much weaker than it was in the beginning of the year, and I think we have to not lose sight of that. But I think partially what's happening is that maybe for investors, what's coming into focus again is the impact these tariffs might be having on other countries. I mean, we've been focusing very much on the US, but I mean, these tariffs have a negative impact on growth potential in other countries as well. Maybe that's coming a little bit back into the foreground as investors try to consider what these tariffs actually mean on a global scale. So that's maybe one approach to look at the recent bounce back of the US dollar, which otherwise, I will agree with you, doesn't make a whole lot of sense.
We're still waiting for what Trump decides on Europe. We've had mixed messages in terms of how close the EU is to a deal with the US. If we fail to get a European deal by August the 1st with the United States, what is the trajectory for euro dollar? The euro's seen that strength. How much downside is there potentially on a failure to strike a deal?
I think there is some short-term downside, definitely, because the market, as you said, is very much sort of hoping or betting on there being a deal. So that will be a considerable disappointment. And then, of course, we'd have to see how the EU reacts in turn and what they impose in terms of counter-tariffs. And that will obviously have much of an impact on inflation trajectory and expectations for the Eurozone and therefore the central bank. So there's a whole lot to consider in that. I think the euro in the short term, if there is no deal, would definitely lose some ground. We have, as I just said, we've seen a massive rally. I mean, we started the year, around 102, 103. We were recently, 118. So we've definitely seen a massive rally. And I think there is some consolidation to be seen here, some trace back from those gains on a short-term view. Having said that, again, we have to consider both sides of that equation. And, higher tariffs are not good for Europe, but they're also not good for the US. So we come back to this sort of trade-off between those two. And it's wait and see. And as you just said, I think someone mentioned on your show early on, the first time these announcements came was a huge shock. Everyone was scrambling to make new forecasts. And you can see now how that's changed. We're sort of wait and see. Well, everyone's sort of just holding their feet still to see what actually comes out of these tariffs. Because, we have learned a hard lesson that you just never know.
Sonia, I'm going to ask you for some levels here on euro dollar. There was some speculation that the EU might receive a letter today. President Trump telling NBC News that he would like to do it today. Let's say this letter has a 30% tariff on the EU. What do you expect euro dollar to do?
Well, we're already down, 116.70 right now. And I think, you can definitely see a good big figure coming off of that if that is the news that comes out of today, because I think that's going to be a significant shock for the market. Also, we have to be mindful of the fact that when you look at speculative market positioning right now, the market is very long euro dollar. So it's a Friday, so you could see quite a sizable move on the back of news like this, given the combination of these factors. So definitely, yes. I mean, you can see a big move. I agree.
Is there a number maybe on this letter that wouldn't spook a market reaction? What kind of number is currently euro dollar pricing in at these levels at 116?
Well, I'd say probably somewhere around 110, so 10, 15%. I don't know if it reaches up to 20. I doubt it, to be honest. I think it's more of a sort of, the baseline was always 10%. So anything significantly higher than that is going to be a negative surprise. But I think probably it'd have to be in excess of 20% for it to have a real big market impact.
Sonia, how do you model an FX forecast when it comes to things like carve-outs, when it comes to things like caveats? Is there some sort of indication that more carve-outs equal less volatility in any given currency pair?
No, I think right now, well, first of all, right now, I think you don't really model forecasts. I mean, you really can't use any models because what we're experiencing is unprecedented, and therefore models are, I'm going to say, useless. This is really a case of going day by day on the news and trying to figure out what you have to take into account for your forecast and what you're better off ignoring for the time being. And this is where we come back to this question of, reliability of Trump's policies. You just never know what's going to happen next. So you have to work with assumptions and adjust as you go. And that's really the only thing you can do. And I mean, if you look at the last 6-7 months, how frequently forecasts have had to be adjusted, have had to be changed, because we are in this very uncertain market environment. I think volatility is definitely here to stay. And I don't see this getting any better throughout the entire Trump term, because I think he's not going to change. So I think we're gonna have to just get used to this for the foreseeable future.
Speak to us about the foreseeable future. I mean, you make this point that you can't actually forecast in terms of things like terms of trade, for example. But does that put monetary policy back in the driver's seat? Is that how we should be thinking about it?
Well, I mean, I would say to a certain extent that's true. I mean, monetary policy is still very much in focus, although we are, sort of nearing the end of the rate cut cycles. I mean, the ECB is almost done. I think that's probably less controversial. The Fed's in a much more difficult position. And I've been following, of the debate, of course. People are talking about, whether the Fed's going to cut. I mean, someone obviously saying the Fed's going to hike rates. I think we have to just keep in mind that these people are dealing with the same uncertainties that we are dealing with. I mean, they do not have a crystal ball that tells them how things are going to go. I mean, the Fed and other central banks are forced to deal with the same uncertainty, and they have to move from one data point, one meeting to the next, and then decide. I still think the Fed's going to cut. I think the timing is difficult, but I think there's still scope for the Fed to cut rates.
All right, Sonia Martin, head of FX and monetary policy research over at DZ Bank, walking us through basically the world that we live in, how it shows up in the FX space. We thank you so much. Coming up, we shift focus to the equity market, and in your stocks to watch, we're going to dive into some of the sectors that could be hit by Donald Trump's latest tariff threats. That conversation next. This is Bloomberg.
Happy Friday. We're about 14 minutes from the opening trade this Friday. European markets cooled lower by 0.6%, with the context, of course, that you've had 4 straight days of gains and a fresh record, of course, on the S&P 500. By the end of the close yesterday, US futures pointing lower by 0.3% on the S&P. E-minis, Nasdaq 100 futures looking to drop about 0.2%. The tariff headwinds pausing at least something of a pause, something of a cautionary note for these equity markets. Kriti, what has caught your eye this Friday?
Well, of course, as we await for those equity markets to open, I want to bring it right back to the FX markets. We just had a fascinating conversation with Sonia Martin over at DZ Bank, talking to us about simply just how crowded that euro-dollar trade is, the long euro-dollar trade. I just want to put it in a little bit more perspective, really emphasize the point. And this is a chart that caught my eye from Robin Brooks over at the Brookings Institution. He was formerly at Goldman, formerly at IIF. Fabulous charts on social media. He made a really crucial point. This is a chart that goes all the way back to 2007. So a very long-term view. The blue line here is euro-dollar. The white line is the trade-weighted euro. So when we talk about this trade kind of getting long in the tooth, on a trade-weighted basis, it's really long in the tooth, to the point that you can start to see this divergence where trade is really moving this, and it really is hitting a high that you have not seen really in the last almost 20 years. I think that's a really crucial piece, that when we talk about this fear of swinging back in terms of those positions, swinging back and really retracing some of that strength in the euro, this is the chart you want to keep in mind, because there is a question here of how much the trade-weighted euro is really a function, ultimately, of what's happening with the U.S. and how quickly it could swing back. There's also the danger, of course, as the stronger the euro gets, the more deflation the Eurozone is exposed to. This is something that happened over in 2010, over in 2011. This is why QE was introduced by Mario Draghi, who was worried about the effects when it came to European exports. So we'll see how that all shows up. as a lot of central bankers right now are talking about the euro potentially becoming the next reserve currency. Be careful what you wish for, as Scott Bessent would say. Let's get a little bit more analysis on this FX market, though. Bloomberg's Paul Dobson, very familiar with the ins and outs of the currency story. Paul, talk to us about that risk. How quickly can things swing back when everyone is short dollar right now?
Well, that is something that FX traders always have to take into account, right? Their positioning can mean that the moves don't go the way that you would normally expect them to be, and you know, there are various things that could get us into a situation where the dollar maybe starts to behave more like a haven again, and we see more cash flowing back into the US, or in a very good news situation for the US as well. Likewise, that could lift the dollar. However, you know, most of the people that we speak to seem to have this long-term bearish dollar position at the moment, perspective. If you add into that the idea that the Fed might be cutting interest rates later in the year as well, that's another sort of drag on the US currency. And in general, if you look across markets, measures of implied volatility are extremely low. So nobody's really pricing in that risk of an immediate or very sharp bounce back, which, again, could perhaps only magnifies the risk of it actually happening.
Paul, we get U.S. CPI next Tuesday. Do you think we're going to get any clarity on the tariff pass-through to CPI, or are we going to have to be waiting until Q1 next year?
That's the thing. I mean, some of the Fed policymakers are telling us it might take a whole year for that to pass through into prices. And it might actually, you know, kind of be in a very much more managed way. You might have this idea or this scenario where there's some sort of agreement between the US vendors and the suppliers in the rest of the world that they'll sort of share those costs somehow and limit the pass-through to consumers or trickle it through over a steady period of time. And so the idea that it's going to show up in CPI data at the moment is a difficult one, particularly when we don't really know what exactly the final future tariffs are going to look like. And I think that you're still hearing that quite a lot from the Fed policymakers. It feels like the possibility of the Fed moving this month is pretty remote. But the market is still priced for 2 cuts this year, September and then another one. And a lot of the policymakers are still talking to us about the idea that that could be where we get it. So a lot will depend on that path of CPI and on the outlook for company earnings and the labour market. But it's hard to read too much from the immediate data that we're getting through when there's still so much fog out there.
Paul, Jamie Dimon says the Fed could hike given the inflation risks.
Yeah. It's possible. I mean, that's a recipe for getting fired from the US government at the very least, right? But I mean, there is inflationary risk, but then there's tariff risk. There's a lot of risks out there. It feels like, you know, the Fed is pretty committed to the idea that interest rates are going to come lower over time and that it's not so worried about it. Yes, you have the comments from Trump kind of breathing down their neck as well. If you look at what we see in the bonds market, you know, implied volatility, the MOVE index is down at the lowest since 2022. So markets aren't panicking about the idea that the Fed is going to do anything that upsets the apple cart anytime soon. It's more those supply dynamics which have been wobbling around the back end of the yield curve that we need to worry about and keep our attention on.
Yeah, that would be quite the outgoing move, wouldn't it, from Jay Powell to hike rates? And you can imagine Trump's reaction to that, or can you? Bloomberg's Paul Dobson, thank you very much indeed. Bring it on. Let's get your stocks to watch this Friday with Chloe Melly. Chloe.
Good morning. So let's start with some tariff news. There's always more. So Trump threatened 35% tariffs on Canada. And one company for whom that might be a little bit tough this morning is Stellantis. So Stellantis has quite a lot of exposure to Canada, a lot of manufacturing facilities there. And that might feed through into a little bit of weakness this morning. We can see that the year-to-date share price minus 28%. So it's probably, those news is probably not going to provide any sort of reprieve this morning. Analysts are very kind of unsure about the company. We're at about 22 holds, a majority of holds, and a quite not negligible amount of sales either. So a little bit of weakness expected from Stellantis this morning. Moving on to pharma, we've got quite good news from Sanofi and GSK. So the Delaware Supreme Court agreed with the companies within the Zantac litigation that the expert testimony that linked the drugs with cancer was not legitimate. So that might provide quite a bit of a boost. So we can see in 2022 there was a dip for both companies. That's when the litigation really started ramping up. But this morning that might provide a little bit of a boost to those two. And then finally, let's talk about the luxury sector. We've got Brunello Cucinelli and reported a 10% sales growth over the first half, and it's also targeting 10% growth over 2025 and 2026. The BI analyst called it an admirable result, which is quite a strong word, and it might provide a little bit more of a boost again to that company. It's already outperforming the market. So it might be a sign of further outperformance, or maybe a sign that the luxury sector is kind of turning around its fortunes a little bit.
A fascinating one to watch. Bloomberg's Chloe Melly with some of those stocks to watch. We thank you so much for bringing that onto the program. We are about 5 minutes, 6 minutes, 7 minutes. I'm going to try to do my math here. About 6 minutes away from the opening trades across Europe. Futures are down, guys. People are worried, or maybe they're just risking off ahead of the weekend. I think it's interesting, though, this is happening because we are also about to hit earnings season at the end of the month. And we've had a couple of guests around the table say, this is where you don't have to start watching for how much kind of tariff provisioning some of these companies are doing. And I'm curious if maybe that's when we see a little bit more reaction from this market.
Yeah, I mean, we've had plenty of guests sit around this table saying earnings season is more important for them than next week's CPI print on giving us any hints about tariff pass-through that hits to margin. But you mentioned, equity futures are down today, but European equities have still had a great week. They're up some 2.5%, outperformed the U.S., so it's still a strong week for the outlook for European assets.
The tariff pass-through is still a bit like waiting for Godot, though. Every time they move the deadline, then you have more time to wait in terms of the macro, the data impact, and you see that split amongst FOMC officials and that lack of clarity. Will we get it when it comes to earnings? There's going to be time to wait for the tariff pass-through. Coming up, it is the opening trade. European futures pointing lower after that good week. This is Bloomberg.
A few minutes ago until the opening trade. Let's talk about how we're set up for today's session going into the weekend, of course. And I feel like this chart suggests maybe not that different from where we ended yesterday's session, specifically when it comes to where the states kind of ended their trading day. The white line, of course, is the Stock 600. You did see it kind of around where the S&P 500 ended as well, which I think tells you that outside of the tariff story from overnight, maybe not a ton of catalysts going into the weekend. Val, what do futures suggest?
We are looking pretty negative, Kriti, on the futures picture, heading into what could be the worst session this week for European stocks. 4 straight days of gains, looking like it could come to an end today. Euro Stoxx 50 futures down 0.5%. Some outperformance when it comes to the FTSE DAX futures down 0.6%. Tom, what stocks are going to be catching our eye at the open?
Yeah, some interesting stories on an individual stock name. Look at the drug makers. GSK will be in focus after a ruling by the Delaware Supreme Court rejecting the legitimacy of expert testimony linking the heartburn drug Zantac to cancer. So that's seen as a major win for makers of that product, which includes GSK, Pfizer and others. So watch GSK open on that story. BP suggesting that the trading part of the business could be quite strong as we lead up to second quarter earnings. They expect to report rising production and a strong result from the oil trading business. So watch BP on that update. And in the luxury space, Bruno Cucinelli's second quarter earnings, reporting net revenue in line with estimates in the first half of the year. Analysts see that as a strong surprise to the upside, given that they've seen double-digit growth across all regions. So watching that stock as well. Kriti.
We'll certainly see how this all shows up on the index level. As Val said, futures are pointing lower. It is going into a weekend, fairly normal to have a risk-off kind of day, but it's also been a pretty risk-on week. As Val pointed earlier, where does that leave the opening trade? Well, it's time to find out. The FTSE 100 right out of the bat, kind of waffling around that 0% level. We'll see if it starts to sell off as futures had initially indicated. This is going to be a crucial one as well, because as you mentioned, Tom, we are talking about BP and the likes of GSK as well. That is all going to show up in how the FTSE 100 trades. And right off the bat, a lot more weakness when it comes to the continent. The Stock 600 down about 0.2%. The IBEX really taking it on the chin there, down about 0.4%. So seeing some pain, seeing some risk-off stories. I'm going to just wait for the CAC 40 to open as well, because that's going to be a key piece of this, down 0.4%. But then I look at that move from the DAX right out of the gate. We didn't even have to wait till 8:03 for that to hit, down 0.5%. And I feel like when the DAX opens that quickly and down that sharply, Val, right off the bat, it suggests some sort of retracement from the gains of the week.
Yeah, let's take a look at the sectors on the move so far in this morning's trade. We are seeing consumer products, the worst performing sector this morning, as long as retail and technology, media, travel and leisure, and auto parts also joining that. Maybe some of those tariff-exposed sectors also taking a back foot. We do have one sector in the green, that's insurance. So it's fairly looking like a risk-off day so far this morning. Tom, any single stocks catching our eye so far?
Well, we touched on the BP story with a look ahead to Q2. So that stock is up 1% right now. So the oil trading business looking like it could be performing quite well, and production set to increase. Of course, we have the broader macro picture of softer oil prices generally. But nonetheless, in the session today, and in the first few seconds, BP is up 1%. Bruno, Cucinelli, we're talking about that story with the earnings coming in line with the estimates, but seen by the analysts out there as positive given the broader environment. So that stock is up just 0.6%. Some of the individual names on the move. Nothing significant on that front. Let's see at GSK as well, because we had that Delaware ruling and we talked about the Zantac story around that. It's been long running, of course. GSK largely unchanged so far on the FTSE 100, of course.
I think it's a day where heavyweights are really selling off. You look at the biggest contributors to the downside, LVMH, SAP seem to be two of your biggest weights. We'll dive into the conversation later in the show with the SAP CEO, which, Tom, I know you conducted as well, get a little bit of a tech taste in there. But at the moment, on the surface, it just looked like a rotation of what we've seen this week. So let's see if some of this price action continues throughout the session. In the meantime, I want to get a little bit more analysis this morning. Patrick Armstrong joins us, Chief Investment Officer over at Plurimi Wealth. Patrick, pleasure to have you. Thank you for joining us this Friday. Jamie Dimon says there's complacency in this market when it comes to the tariff threat. We've seen it. We've seen volatility barely compressed despite the tariff threats increasing. Does that make sense to you?
I'm worried I'm complacent because I am looking through it a little bit. There's threats all the time. We've seen what's happened in April, put in place, pulled back. So it's called the taco trade. I do think that continues. I think extreme threats are put in place and then walk back to more moderate views. I don't think the policy is good for growth, but I don't think the extreme tariffs, 20% blanket tariffs across, will end up happening. And if they do happen, they're short-lived. So I'm potentially complacent myself, but I do think that's probably the end game for where we get to.
Well, talk to us about then, what is that red flag to you? What do you think there's that line in the sand that says, okay, maybe I need to do something here?
Yeah, you have to call his bluff almost at this point. You've got to wait to see if they do stay in place, and markets punishing Trump get him to change his mind is how I feel. So I think you've got a self-correcting mechanism with bond yields and equity prices. Trump won't want to cause a significant recession, a long-lasting recession. He may be able to handle a short recession, but a bear market and a spike in bond yields, it's not palatable to him, and that will normalize his behavior, I believe.
Yeah, Patrick, that sounds like he's going to be more emboldened by the S&P 500 reaching all-time records yesterday. I mean, he could possibly go further with universal tariffs, sectoral tariffs, these tariff letters he's sending out today. Is that the kind of impression you get?
He may think everything is good and everything he created, the storm he created in April, is now past new all-time highs. But, yeah, the market will react to tariffs if they are put in place and they have teeth that are long-lasting. I think you would see another correction and probably a moderation of policy. I don't think this is a winning policy. I'm not sure he views it as that. I still think this is, unfortunately, in the opening gambit type thing where he was hoping to provoke a wave of trade deals from April through August. It's not happened, and I think he's hoping this will be a catalyst for that.
Okay, what do you, I mean, at least the one country we've not gotten a lot of news out on is the EU. Seemingly, we're inching closer to a deal, but then Trump told NBC News yesterday that the EU might receive a letter today. Where do you stand on those negotiations? Do you think it's impactful? Are you following the story?
Of course you follow this story. There does seem to be progress made, but yeah, at the last minute, Trump can send that letter and hope that's a catalyst to finalize a deal, but it can have the unintended consequences of making a deal fall apart potentially as well. So it's something that's a risk. It's something I expect will actually happen, but I don't think there'll be a long-lasting effect from it because I think that will provoke both sides to get to what will end up being a deal.
Patrick, you still think Europe outperforms the US this year?
I do, yes.
What kind of deal derails that assumption?
Well, a deal wouldn't derail it, I actually think. I don't think the EU would do anything that's punitive to their economy. I think the EU's got enough clout that any deal will not basically get rid of European manufacturing. The U.S. will still have its big trade imbalance that they're trying to get rid of. I don't think that does end. But a no deal would maybe change that view, but I'm not sure it would. The parts of Europe I'm investing in aren't so much on trade. They're on German infrastructure spend, Heidelberg Materials. It's a boring cement company. It's not going to be derailed by trade. European defense stocks, these have structural spending ahead of them. Europe may be moving away from U.S. arms producers towards European ones in a trade conflict. So you can sort of be long Europe and not worry about the trade as much as it may on an LVMH or an exporting company like Pernod Ricard, those kind of things.
Where's Anna Edwards when you need that? She loves a cement stock.
Love the whole thing.
Patrick, that's really interesting. There are parts of the European equity market that continue to outperform even if there's no deal, and that's interesting. You are also, though, at the same point, raising the red flag around inflation risks. And you're saying that's underestimated in terms of the inflation
definitely. Story. I just don't see any scenario where you get this immaculate decade that inflation swaps are pricing in, because we've got populist governments all around the West, and austerity is not being considered for the debt, raising taxes, the opposite's happening. So you need incredible growth. That's how you can grow your way into the debt. It's not going to happen. The White House says it's going to happen, but you're not going to get the 4% growth you'd need to grow your way into the debt. So it's a debasement strategy. That's the end game of populist strategies, is printing new money to pay off the old debt, and unequivocally inflationary. Everything Trump's putting in place, apart from deregulation, is inflationary. So tariffs, trade wars, real wars. There's going to be environmental issues at some points in the next decade that create supply chain disruptions, and the market's just pricing perfection. Fed's going to deliver its target, nothing to worry about, but there's so many forces creating potentially intermittent spikes, not maybe structural every year very high, but there will be spikes in the next decade. Market's not pricing that.
It's like when you have a long list of things to worry about and to do, you just don't do any of them, right? At least that's how I operate. Talk to us a little bit about, you made a key point here, that the Europeans are not going to do something that's punitive to their own economy. Yet you have a lot of central bankers who are really cheering on the strength of the euro. How punitive is a strong euro to an export-based economy?
True. That's... If you're a central banker, that helps you deal with inflation very easily, because you're not importing inflation, basically, because your currency is so strong. But the ECB has cut rates very consistently. You're getting monetary stimulus that's offsetting currency strength. And not sure how much is left in that, probably a couple more cuts. But the monetary stimulus is offsetting the currency headwinds, I believe.
Patrick, staying on monetary policy, you were just talking about how it seems like the U.S. is going for a debasement strategy when dealing with their debt. You combine that with perhaps political pressure on the Fed to keep rates low. I mean, that just smells of fiscal dominance. I mean, surely the market is going to take that negatively at some point.
The bond market should. The equity market, that's a hit because you're probably discounting future cash flows at higher interest rates. But it's also, in the short term, it's a sugar rush. Everything that's populist is great in the short term, long-term consequences. And right now, the market's rewarding stimulus measures. Debasement strategies aren't explicit right now, but I do think the market probably responds to a Fed funds rate that's too low, that does stoke future inflation, but that'll stoke an equity rally as well.
So equities will rally even though the Fed is cutting just under political pressure. You don't see them taking it as a negative
Equities always rally when there's monetary stimulus. So if there's growth and monetary stimulus, that's a recipe for equity rally and a spike in longer-term bond yields, probably.
But, I mean, surely if inflation spikes off of that, say we've got political pressure on the Fed, they're cutting into what is maybe or maybe not persistent inflation, surely there's at some point the equity market breaks under that.
Eventually you do, because eventually you either have spiraling inflation or you get a Fed that behaves in line with its mandate and raises rates to counter the inflation that's being created. So the risk is you get a populist president who puts in an extreme dove as the next Fed chair, who does put the 1% interest rates Trump's talking about. So I doubt that happens. I think we've got some Fed people right now who likely will be the next Fed chair who are reasonable, but they are very dovish. So you'll probably have a bit too much monetary support. That the consequence of it's in the textbook. When monetary policy is too easy, it stokes inflationary flyers down the road.
Patrick, very quickly before you go, you own 4 of the Mag 7. Nvidia is one of them. Do you take profit now? It's at 4 trillion.
It's not a bad idea. I'm not taking profit, but it is back to a lofty multiple. I wouldn't want to sell these companies going into earnings. I think you probably have another leg up on the results that come. Nothing's indicating a slowdown in AI data center spending, so I do think you'll see good results.
All right. The view from Patrick Armstrong, Chief Investment Officer over at Plurimi Wealth. We thank you so much. Let's get a quick check on the core 6, the heavyweights that tend to move this market. And red across the screen, you can see the biggest contributors to the downside, actually, in the Stock 600 are LVMH, are SAP. So it really tells you that a little bit of cash moving out of some of the outperformers of the week, actually, across the board. Pain on the screen. Schneider Electric, though, almost flat, only down 0.1%. So perhaps they're the exception to a fairly broad sell-off. Let's get a check on some of the other individual stocks on the move. Chloe Melly has that update for us. Chloe.
Good morning. So let's start with some companies with exposure to Canada. So Trump announced or threatened 35% tariffs on Canada, and that's having a little bit, well, at least at the open, it was having quite a bit of an impact on those companies that have exposure there. So Stellantis was down by about 2% at the open. It seems to have been bearing some of those losses. It has a lot of manufacturing facilities over in Canada. We've also got Siemens Healthineers, and then over in the defense space, Hensoldt and SAP are also quite exposed to the country. But so far, it seems Siemens Healthineers is the one that has really the biggest drop at 1.5%. Moving on to DNB Bank. So DNB Bank is the first of the Nordic banks to report this earnings season. It is down 7%. It reported a miss in net interest income. Obviously, the rates are coming down and really weighing on that key metric for banks, and that doesn't spell the best news for the other Nordic banks coming up next week. Then we have Norwegian Air. Norwegian Air is up 8.8% this morning. It reported operating revenue that beat estimates, and it seems like travel demand is really strong there. And then finally, to finish off today, we have got BP. BP is up 1.7% this morning. It said that it expects second quarter production to be higher than first quarter production, and that's really driving the stock this morning.
Chloe Melly from our equities team. Thank you very much indeed with some of the stocks on the move. Coming up, another week, of course, upended by those trade and tariff tensions. We're going to take a look at the top 10 companies to watch, though, in the third quarter. That report from Bloomberg Intelligence is next. This is Bloomberg.
Welcome back to the opening trade. About 16 minutes and change into today's session. Red on the screen across the board, except for the FTSE 100. I'm going to say virtually unchanged right here in London, but we certainly have a sell-off on our hands, even in the DAX, down about 0.6%, but perhaps just a retracement of the gains that we have seen throughout this week in this region. Let's talk about earnings season. It's right around the corner, and Bloomberg Intelligence is out with a list of the top companies to watch this quarter. Bloomberg Intelligence Director of Research, Tim Craighead, joins us for more. You've got 10 companies on your list.
Yes.
I'm not going to ask you to tell us all 10. What's your favorite?
Well, put these into context. These are 10 that we've zeroed in on that are a broader group, that are part of a broader group of focus ideas that we have, which are high conviction ideas that we think are differentiated, and we see catalysts ahead. These 10 all have catalysts coming up over the course of the third quarter, and that's why we've selected these things. By the way, for terminal folks, you can find it on BI Focus.
I'm intrigued. There's a number of consumer names on the list at a time of macroeconomic challenges, at a time when the consumer in the US, even the US consumer is feeling a little strained, tariff risk. What is the rationale for having some big brand consumer names on this?
So there's one underlying thread, and that's the higher end consumer that we do think is less susceptible to some concerns that are out there that are well founded. Think Diageo. Stock has been under huge pressure. Their sales last quarter actually were much better than anticipated, and we think that will continue. They're actually coming over in a bit of an overhang, a hangover last year of inventory, no pun intended.
Like what you did there.
Yeah, there you are. Another high end that you wouldn't think about is Dick's Sporting Goods in the U.S. This is a sporting good retail shop, but they tend to go towards higher end demographics. They've got a big new store format that's accelerating pace. We think it's well positioned. Aston Martin's also high end, but we have a cautious view. Yeah. The high-end luxury sports car market is oriented more towards V12s. Think Ferrari, think Lambo. Aston Martin's struggling, and we think there could be a capital raise coming.
Talk to us about how tech is taking any center stage in your top picks, because it's been one of the key drivers of the U.S. equity market, of the global equity market rallies that feature in your picks.
Absolutely. And if you look at the 50 companies to watch in the year ahead, the last couple of years, they've been embedded with AI names. It's true this time, but in an unusual twist. We've got Cadence Design, which is software company that focuses on design automation equipment. So you use their software to design chips like NVIDIA and Samsung, who are both customers. So that's key. Another is one, Keppel DC. You've probably never heard of it. It's an Asian REIT based in Singapore, which is becoming a bit of a hub for the hyperscalers and LLMs within Asia. This is the company that has the real estate where you put the AI data center. Really interesting story. Rents are going through the roof.
So you've named a couple of long-term trends. You've talked about the tariff threat, sort of. You've talked about kind of this wealth disparity with some of these names as well. Talk to us about how the financials show up and kind of bridging those two themes.
Yeah, it's interesting. So you think right now is really convoluted with central bank policy. You know, some central banks are lowering, some are raising. You look at banks, there's pluses and minuses. We've set that all aside, actually, with two names on the list. One is Capitec. This is South African bank, low-cost, retail-oriented, but they're taking their low-cost model and they're moving it into the small business realm and into insurance. We think they're taking share. Revenue growth is quite extraordinary. The other one that we've layered in on with financials is AIA. And this is an insurance company in Hong Kong. And it's all about Chinese moving wealth, diversifying wealth out of China, which they're using Hong Kong as a hub. And also AIA in reverse is expanding its own footprint across China, across provinces. So there's two growth drivers that take it out of the interest rate cycle story.
A fascinating one as well. We're going to keep watching these. It's interesting. You're not picking on a lot of the heavyweights, but we will keep our eye on that. Director of Research at Bloomberg Intelligence, Tim Craighead, walking us through his favorites. Tom, speaking of heavyweights.
European tech giant, SAP. Thank you for that segue. The recent growth has been powered by a pivot to the cloud, with the company leaning heavily into artificial intelligence, a subject we were just discussing there with Tim Craighead. Now a leader in that space. As part of the latest episode of Bloomberg Tech Europe, I asked SAP CEO Christian Klein if Europe does actually need to build more data centers.
You need chips and data centers when someone is consuming it. But, you know, there is not, the same demand for these chips in Europe like in the United States, where you have a lot of companies who need chips for training their large language modules, etc. Here, I mean, of course, when you now apply AI, develop software, develop, new AI use cases, of course, there will be at a certain point also a higher demand for chips and for data centers. But, now just focusing on the infra layer, on building data centers, I would predict there is for sure not so much demand right now. So you need to come also from the demand layer, from the top, from the software, from the AI layer, where, again, the ways is not decided yet. And then, of course, what that drives is then finally more demand for chips, but in that order, not necessarily just building data centers for the sake of building data centers.
Is the EU AI Act, is it a hindrance to our development of this technology or a catalyst? How do you see the regulatory environment when it comes to AI?
I mean, when I'm sometimes, talking in Brussels or in other, councils in Europe, the first topic is always regulation. And I wonder sometimes, can we maybe first talk about competitiveness and opportunities and how we use now AI to make our industries more competitive? And because then, when you are leading there, then you can ask also the question how to regulate. I mean, honestly, I don't see in Europe now so many AI use cases who need now deep regulation so far. Now, regulation, I'm not against it. The problem with regulation and with the AI Act is, I would say Brussels come in with the absolutely right intent. They say, you know what, this technology needs to be regulated. I'm not against that, as long as you're regulating, business outcomes, and you also ensure there is a fair competition. I'm absolutely in for that. The problem here in Europe is they're having all the right strategic intent, but then they are putting this in place. But the member states, they just keep what they have, and then you're just adding another layer. Because then you have AI policies all over the place, and then they're overlapping, and the one data protection officer says that, the other says that. It's like going to 5 doctors and they tell you 5 times a different thing. And now you imagine you are a startup and you want to scale your technology, and in every country you are going in Europe, you hear a different story on how to adhere to any kind of AI Act.
And you can catch more of my interview, which is exclusive, by the way, with the SAP CEO online in this month's edition of Bloomberg's Big Tech Europe. Bloomberg Tech Europe. It is big. It's the biggest company, publicly listed company, of course, and the biggest tech company in Europe as well. Look, Christian Klein, really interesting. He has driven and led this company since April of 2020. When he first took over as sole CEO, he pulled the guidance, the 5-year guidance. The stock collapsed 30%. Since then, it's up about 170%. He's repositioned the business towards the cloud. He's lent into AI. There are big question marks about whether or not that can continue and can extend. It's pretty richly valued, this stock. He pushed back on Jensen Huang's idea that you need to build data centres and at pace in Europe. He says there isn't the demand for that, and that is a misallocation of capital. He says that's not the way and where we should be focused on Europe, which was interesting. And on regulation as well, he was clear. Look, you have this EU AI Act on top of the 27 nation members of the EU. And then on an individual basis, each country has their own regulations. He says that's a thicket of regulations that is preventing scaling of some of these AI companies.
What was behind his comment around data centers? It seems a bit off consensus, or maybe is he more focused on the higher energy costs here in Europe? His
point to me, there is the energy cost piece, definitely. He didn't land there. He landed on the fact that this is a huge cost, and there isn't the demand because we don't have the large language models that need those data centres to train. That's why you need the data centres in the UAE. That's why you need the data centres in the US, because you have Anthropic, because you have OpenAI, because you have what's happening with Meta. They need to train their models on those data centres. He says, we don't have that in Europe. We have one, Mistral, not enough to require all those data centres. He says the focus on capital spend should be around on helping companies build applications on the layer when it comes to AI. It's a controversial position, but that was the line he took.
Well, we'll see if it yields quite literally yields returns, but also yields kind of rallies the troops, it feels like, when it comes to getting some momentum in the tech space behind Europe as well. We're going to continue that theme in just a little bit. We're going to stick with that technology story and whether Europe can break its dependency on U.S. big tech. This time, the view from Amazon Web Services. Tanuja Randery, who is the EMEA managing director there, is going to be joining us around the table for an exclusive conversation on where Europe stands in this broader tech revolution. Stick with us. This is Bloomberg. This is the opening trade about 30 minutes into today's session. We've got a sell-off on our hands across the European indices. The DAX down about 0.5%. The FTSE 100 is, we'll call it the outperformer. It's flat. It's not selling off. I think that's good news. But I think the takeaway you want to take from today's session is simply that it's a retracement from this week's gains. It's also a Friday. There's potentially some risk of headlines over the weekend. I think the market's bracing for that this morning, Tom.
Let's get to tech right now, amid that concern around tariffs, of course, and the trade picture. Also a factor, of course, when it comes to the tech story. But Europe is pushing for technological sovereignty, and that's part, of course, of the bifurcation that we're seeing in terms of the US and Europe, certainly. With growing ambition here in Europe and urgency, of course, the continent missed out on the opportunity to create global internet and cloud companies. Now it depends on US and Chinese firms for some 80% of its tech infrastructure. Our next guest says the US and China threaten to leapfrog Europe once again, this time on AI sovereignty. Tanuja Randery is the managing director for EMEA at Amazon Web Services, joining us now for an exclusive conversation. AWS, of course, the beating heart of the revenue stream for Amazon. Tanuja, thanks for joining us in the studio. So there is this push right now in Europe around data localization and sovereignty. Is that a headwind or a catalyst for AWS?
Well, I mean, maybe just to step back and why we're talking about sovereignty as well is, you know, when we look at the adoption that we're seeing on this Gen AI technology, it's phenomenal in Europe, actually. We've seen about a 30% acceleration just in the past year alone. And that goes from startups all the way to governments and enterprises in between. So for some of those companies who require more enhanced sovereignty or enhanced security, they prefer to see a cloud here in Europe. And actually, we're very excited that this year we are launching in Germany our European Sovereign Cloud. And the reason we're doing that is while the public cloud that we offer across various regions in Europe is sovereign by design, for those enhanced sovereignty requirements, they want something that's independent of any other region. And so in Germany, we'll have this. It'll be independent of any other region. It'll be controlled, secured, and built here.
I don't want to sound like hyperbolic or paint an extreme scenario, but we're in a trade war right now with the US. If we got to some kind of scenario, it's an outlier, clearly, where the Trump administration turns around and says, actually, we are so annoyed with what Europe is doing in terms of targeting our tech companies, just pull the plug on Amazon. Does that data center, does that sovereignty, does that cloud service remain in that extreme scenario?
So in the case of all of our data centers, by the way, not only the European Sovereign Cloud, customers are the only ones who have access to the data. They're the only ones who can move it, by the way. We don't actually see the data. We're just supporting them with the infrastructure that is secure and resilient. In the case of the European Sovereign Cloud, in the case of any connectivity disconnect, that cloud can still operate independently. So, however, I will tell you that, you know, if I think about all of the administrations we've worked with over time, and we have a lot of experience doing that, we've been operating these clouds now for over 15 years.
Yeah. So I was speaking to Christian Klein of SAP, and he kind of pushed back on the narrative that Jensen Huang has been trying to sell in Europe, which is if you actually want to catch up and play a role in AI, you do need the data centers. And Christian Klein is saying, no, that's not really where we need to be focusing our capital because we don't have the demand here. And he was talking about the large language models. On that piece, is Christian Klein right in terms of the particular data centers supporting large language models? What is the need for data centers in Europe right now?
Well, look, again, I'm going to go back to the data because it's super important. I mean, if you see the adoption we're seeing for this technology, right, and I'm talking about 5 businesses every minute in Europe are using this AI technology. It's outpacing the mobile phone uptake of the 2000s. And as I said, it's all companies. And the benefits they're seeing are not only what you would expect with AI, which is productivity, but they're actually seeing revenue increases. And I think that's why they're leaning into this technology in a big time. Now, to enable that, you need cloud. You actually need modern data foundations, actually no data, no AI. And then, of course, you need the data centers to be able to house these servers so that those companies can use both the models, but also be able to fine-tune their own and drive their own inference use cases. And I'll give you an example of what we've done, which makes it easier for customers to do this, right? We have something that we call Amazon Bedrock. I won't get too technical on it, but what it is it's a platform that gives businesses the availability of all the large language models. Now, I can't say all necessarily because we only have a few on, but if you take Claude, the latest Claude is 4.0, that's on Amazon Bedrock. If you take Mistral in France, that's on Amazon Bedrock. Our own Amazon Nova is available through Bedrock. Meta's Llama is available through Bedrock. But Bedrock provides a platform that people can actually use, leverage those models, but your data doesn't leave your environment. And I think that's really important. So, yes, there's a huge uptake of usage of this technology across businesses. And for that, you absolutely need cloud and data centers.
Well, for cloud and data centers, you need the energy to power it. Tanuja, we had a conversation, I want to say a few months ago, with the Brookfield head of infrastructure, who was so positive on the AI data center rollout. with the caveat that France is leading because they have the access to the nuclear power to energize it. How does the rest of Europe catch up to the ability that maybe France has the lead in?
It's true. Every single thing we do in our daily lives needs energy and electrification, right? I mean, whether you're hailing a cab or social media or streaming streaming on Netflix or shopping online, all of that needs energy, data, cloud. What we've been very focused on is ensuring that our data centers are extremely energy efficient. So I think what's very important is, yes, they consume energy, but it's important that we're actually constantly looking at ways to drive down the energy consumption and be really, really optimized. And in fact, Accenture published some research recently that says that our AWS data centers are actually 4 times more energy efficient than what is on-premise in the data center. And why is that? Because we are optimizing at every level. So if you take chips, for example, that are in the data center and they consume power, our chips, both on the compute side, which is Graviton, as well as on the training side, are actually way more energy efficient than comparable instances in the past. So, for example, our Trainium 2 chip is 60% more energy efficient, right? Yeah. So we have to do everything we can to actually drive down and optimize energy usage. And then we're also really very focused on carbon-free energy. Right? It's really, really important. All of our infrastructure, by the way, today is matched by renewable energy around the world. So I think that's super, super important. It's not an easy task, but we are constantly looking at ways that we can do it. And in the US, we are actually working on nuclear power as well.
That's a very expensive prospect. I hear you on the energy efficiency story as well. But here in Europe, energy security is an issue, and it gets very expensive very quickly. Just take a look at heating bills in the winter. I'm still very upset about that. Talk to us a little bit about how you approach the forecasting of some of those risks. I hear you on the energy efficiency, but in terms of the supply story, what do you see as potential hurdles to that consumption story?
Well, look, I mean, all of our teams that are building our data centers around the world, and I think there's no compression algorithm for experience. We've been doing it for many, many years. They're constantly looking at ways. So, you know, we have data centers in Spain. We have data centers in Switzerland. We've got them in Frankfurt. We've got them in London here in the UK.
You just named countries that have struggled famously with the grids and the renewable energy there.
We do 3 things that I think are important. One is we are the largest acquirer of corporate acquirer of renewable energy around the world, Amazon, that is. 2, we are constantly also commissioning solar and wind farms, by the way, here in Europe to make sure that we have access to that energy. And 3, as I said, constantly looking ways at optimizing the consumption. I think, look, this is a story we have to constantly monitor and keep working on.
Let's talk about a region of the world that maybe doesn't have high energy costs, and that's the Middle East. Trump had a successful tour of the Middle East. It seems like it's becoming a hub or wanting to become a new AI hub. How are you viewing that region in your business?
It's a very exciting region, actually. I personally spend a lot of time in the Middle East. In fact, very recently, we announced the launch of our region. When by region, I mean our data centers in Saudi Arabia. So that will be there actually in 2026. And at the same time, we announced a partnership with a company called Humain, Humain. We are going to launch a first-of-a-kind AI zone with Humain in Saudi Arabia, which provides our bedrock services, as I mentioned earlier, and other solutions to both businesses and government in the KSA region, but also increasingly across the GCC. So very exciting. We have a region in the UAE as well as in Bahrain. And we're seeing some very exciting things both in the government as well on the commercial side.
And you also mentioned issues around AI skills and talent. We know, for instance, at least in Mark Zuckerberg's mind, he's on a massive talent war campaign right now. How are you guys dealing with that?
Yeah, so, I talked about the demand increase on the one hand, and it's great to see that. But there are 3 probably barriers to accelerate adoption. And I think for Europe, if we want to unleash, almost as we estimate 400 billion in economic value by 2030, there's 3 things we got to do. One is skills, the second is regulation, and I think the third is funding. On the skills side, right now, every one of our jobs is, obviously impacted by AI. And I think what I would say is it's super, super important for us to make sure that we are training and upskilling all of us, each one of us individually. By the way, I use tools. I'm sure you're using tools here. Tools are being used in content creation and content production. I think it's important, training and upskilling. So we're focused on that, really, really. And I think the mindset that companies need is that we are calling an AI mindset. And an AI mindset is all about rethinking your processes end to end and redeveloping them using AI at the core. And with agentic AI now, which is these autonomous software systems that are going to be able to plan, act, and reason on your behalf, there's a real opportunity to completely refine end-to-end processes, drive productivity, and then reinvest those savings in growing businesses, right? So I think those are some of the things, but training is the biggest issue. I mean, only 25%, by the way, of businesses feel like they've got the digital skills they need to be able to accelerate adoption of this technology.
Where does that leave, then, your hiring plans in the region? Because tech is, in general, tightening in terms of jobs, and we've seen job cuts at some of your competitors like Microsoft. Give us the picture in terms of the hiring story for AWS in EMEA over the next 12 months.
Well, look, I'll say a couple of things. I think normally with any sort of change, there is anxiety that comes with it, right? So, and this is probably one of the biggest transformations we're seeing, maybe beyond the internet, actually, certainly beyond the cloud in terms of its impact across every sector, every process. Historically, when we look back, tech has always actually created more jobs than taken them away. And I don't even know if we know what the jobs of the future are going to be. I don't think we have the crystal ball, actually, to say that. What I do see is that companies are investing in this technology to improve employee efficiency. BT, for example, using coding tools to really drive 12% of the tedious tasks that are really worrying for coders, releasing that, and then redeploying those resources elsewhere. You've got startups launching new businesses that are hiring. We, by the way, if you look at our region across the world, and if I look at the Middle East as an example, emerging growth region, Central Eastern Europe, emerging region, we are absolutely investing in resources there. But at the same time, we recognize that we actually have to change the work we do and change the actual work our employees do and make their lives much more exciting.
12 months from now, is your team bigger or smaller than it is now?
It's hard for me to predict because the way we always think about these things is we work backwards from what our customers need, where's the demand, and then we work through our business plans, right? So for me to sit here and say, can I tell you where I will be in 12 months? I don't know, but I will tell you I'm super excited about the impact that this technology will have both on us, but also on our customers and partners.
All right, Tanuja Randery, Managing Director for EMEA over at Amazon Web Services, giving us a little bit of insight into how the thinking around Amazon. We thank you so much. Coming up on the program, we're going to dive into the latest between the UK and France as they agree to swap migrants in a one-in, one-out deal. We'll have a wrap on the Franco-British summit, a massive moment for domestic politics right here in the UK. Stick with us. This is Bloomberg. Vietnam's trade deal with the United States includes a 20% tariff rate, but also gave it, quote, first mover advantage in Southeast Asia. Bloomberg Originals has been investigating why Vietnam needed to secure the deal right now. Here's a preview.
A land once devastated by American bombing now accounts for half of Nike's global shoe production. Hundreds of other American companies and their suppliers have manufacturing bases in Vietnam, too. As the Southeast Asian country's annual GDP climbed, exports to the U.S. grew. Now, Vietnam is one of the countries most dependent on American trade.
The United States is Vietnam's largest export market.
Vietnam's massive trade surplus with the U.S. has made it a key target for Donald Trump.
The problem is they charge us 90%. We're going to charge them 46% tariff.
If Vietnam were to lose access to the American market, that would have a profound effect. It would ripple across the economy.
Which is why this was imperative for the Vietnamese government.
President Trump says he's reached a trade deal with Vietnam following weeks of intense diplomacy between the two nations.
Unlike military conflicts, trade wars are at least fought without bloodshed. But they can still do damage. And even with a deal, the economic relationship between the U.S. and Vietnam faces an uncertain future.
Subscribers can see that documentary in full right now at the terminal or the Bloomberg.com. It'll be available, of course, later on the Bloomberg Originals YouTube chat channel. I think with that preview, I'm sure they'll hit this in the documentary, missed is simply this idea that Vietnam does provide a major hub for a lot of retailers. Nike, for example, among many, many others. When there's a question here, and I think one of our opinion writers a couple years ago had this great column about how long it takes to ship a pair of Air Jordans from the likes of Vietnam to the United States, and it was something like 180 days. It was talking about COVID supply chains, but that has only gotten to become more complicated as we talk about the tariff story. And I think that was a really fascinating part of how the trade deals, not just with Vietnam, but with Malaysia, Cambodia, et cetera, shows up in actual inflation, things that we buy every day.
And then you have to take into account how long that might be sitting in a warehouse, and then, by the time it actually makes it to the store shelves and bought by a consumer, how long is that? Because that is going to be very key for how long we're sitting here waiting for this persistent inflation to come from tariffs.
And Vietnam is also a story about how you balance the geopolitical needs of the US, which, of course, Vietnam is an ally in terms of a partner versus China. And the trade story, because, of course, Vietnam has also taken a lot of the factories from China where they've repositioned to be able to ship into the US market. And clearly, the Trump administration have woken up to that and now are trying to target tariffs on Vietnam because of that partner, because of that play around manufacturing. And yet they need Vietnam to be a partner when it comes to a bulwark to some extent against China.
Absolutely. And the currency impact is so crucial in that because some of the other competitors in Southeast Asia, there's a question here, especially from the Trump administration around currency manipulation, et cetera. Vietnam has skirted that label so far. We'll see if that changes as more people get exposure to that currency.
Let's get to more details in terms of the closer relationship between the UK and France now, because we have, of course, had the state visit by the French President Emmanuel Macron here in the UK over this week. Britain and France, as part of that, and at the tail end of that visit, agreeing to exchange migrants as part of a plan to deter illegal crossings by boat. The deal was struck by Keir Starmer and Emmanuel Macron, wrapping up that state visit, of course, from the French president to London this week. For more, let's bring in Bloomberg opinion columnist Lionel Laurent. Lionel, how significant is this? It's seen at least as a domestic win here in the UK for the Prime Minister. We're going to trial this agreement, of course. How is it playing out in France? What does it tell us about the Anglo-French relationship right now?
So I think this is definitely more of a British issue than a French issue. The French perspective, as Macron tried to say when he was in London, is that it's a completely different story here, because here in France, the border is seen to have been externalised from the UK to France. In other words, France is behaving as the kind of border guard for the UK and getting a lot of criticism for it. And as Macron also tried to explain, this idea of kind of taking British money and not doing anything with it is also very unfair, given France is spending far more also on all this border security. So I think the general picture is this is just a more constructive step, because Brexit really poisoned the well of this very long and intractable border dispute. And this will be a test of political will, because this kind of agreement seems like it's a logistical thing, seems like it's a legal thing, but in the end, it's political will that will actually make it work, as we've seen with other deals like it, such as EU and Turkey.
Lena, so that's kind of the story on the migrants, but talk to us a little bit about this nuclear cooperation deal that was agreed on. Is this something you see as progress on the continent?
I think it's potentially pretty significant. Both the UK and France are the kind of only nuclear powers in Europe, and making some kind of step towards coordination, even if it's definitely not anything like sharing and not a change to the nuclear doctrine, that's an important signal. It's a signal to Donald Trump, because it says that Europeans are going to really step up more when it comes to defense. And it's a signal to Vladimir Putin to say nuclear deterrence is not just going to be decided by Trump and NATO, and countries are getting serious now about investing in the nuclear deterrent, even if we are a long way from a new kind of nuclear umbrella being unfolded over the continent. I see it more as a kind of interesting step towards a new insurance policy when it comes to security.
Bloomberg opinion columnist Lena Laurent, we thank you so much walking us through some of the crucial conversations between the UK and France in this week. As he was speaking, we did see some headlines across the Bloomberg terminal when it comes to the story around the ECB. Isabel Schnabel, of course, the chief economist there, making some comments around the strength of the euro. I think this is a really fascinating one. She's clearly tuned into the show for the last 2 hours, making some comments in EconoStream, saying that another cut would need material inflational deviation, also saying that the risks to the growth outlook are more balanced, reiterating that the economy is proving resilient. But I think the headline that stuck out to me is that there's the concern around euro strength that would weigh on prices. She calls it exaggerated. So that's going to be a crucial piece of the conversation as we see a lot of central bankers saying euro strength is actually a good thing. Exporters in Europe perhaps worrying just a little bit. With that thought, I should mention it's Friday. Let's do something fun on this Friday going into the weekend, which brings us of what we can look ahead to when it comes to Saturday and Sunday. For me, top of mind, I'm sorry I'm not there, the running of the bulls over in Spain. Not that sorry because I don't run,
Pretty
but
right
but I think it would be fun.
You would.
I would run if a bull was chasing me. Yes, this is true. There is, of course, also the Wimbledon finale, the FIFA World Cup finals, lots of soccer in the space, and the Scottish Open, which I think refers to golf and not tennis.
It
right,
does.
Tom?
It does indeed. The tennis is in Wimbledon. The golf is in
Yeah,
Scotland.
but hey, Kriti, we got an American in the Wimbledon ladies final to watch tomorrow afternoon, 1:30.
She was seeded like 165 last year.
Yeah.
Brilliant. She's 23, 24 years old or something. That's one
First
to watch.
American in the women's final since Serena Williams.
Yeah, that's going to be a great game. Right, it is tourist. Meanwhile, it's tourist high season in New York. So from Wimbledon to New York right now, but things are quieter than usual, apparently. The city is set to see visitors drop 17% from last year, a loss of 2.5 million people. But if the Big Apple is dimming as a destination, its brand is more powerful than ever in London, while where the New York influence is pervading the food and drink scene on multiple fronts. Bloomberg's food editor, Kate Crader, joins us for more. Kate, what is behind all the New York food and drink talk in London? This is one that has apparently passed me by, but it's a thing.
Really? Well, if you look, I'm excited for you to go eat some pizza, have some steak and some oysters at restaurants.
Yeah.
It's kind of exciting for me because I'm a New Yorker, but there's a pervasive New York food scene happening. Maybe you've seen it some places, even I think Pret. There's these supersized cookies that looks like scones. They're doughy. I think they're delicious. There's all this New York floppy-style pizza happening everywhere.
Is that what defines a New York pizza? It's when it flops?
Basically, yeah.
Is it
like
not the
wearing a
oil? Is
napkin.
it not the dripping oil?
It's definitely, you want some drippy tomato saucy thing on it. But
And it's a slice, not a whole pizza.
It should be a slice. Here, you guys still believe in pies, but you can find some slices at some places. But definitely, if you're going to eat New York-style pizza, have some napkins, maybe a bib, like be careful.
Style.
But it's also, the exciting thing for me also is that there's a New York-style pervading dining rooms right now. And it's really fun. You see it in some food. You see it, there's a lot of steaks, martinis. There's seafood platters, like seafood towers. But it's also just a style. It's like a comfortable, people being familiar, people being comfortable. Like the waiters can make conversation with you. Sitting at chatty waiters.
People can take chatty waiters.
Exactly. Well, let's see. But it's really encourages walk-ins. There's much more spontaneity. I think Brits actually like to make reservations, and they also like to have a culinary experience.
We are hitting a commercial break, but noted, pizza slices in London. That's where it's at. Stick with us. This is Bloomberg.